Hi, I'm Suneel Maheshwari, Professor of Accounting at Indiana University of Pennsylvania. Today we will be talking about the financial statements. This is the introductory chapter in financial accounting where we'll explain how accounting is the language of the business and go over the financial statements that are prepared by the accountants to communicate with the decision makers. So what does accounting do? It measures the business activities and then processes the data into reports and communicates that reports to the decision makers. And that is why it is also called the language of business. Now, investors will make decisions about the corporations. Corporations conduct various activities, and these activities are measured by financial accountants, and then reports are communicated back to the investors and any outside parties or which are interested in those financial reports. Next question is, what are the activities that accountants measure? When we talk about activities, we are looking at financing activities, which relates to the transactions with the owners or the lenders. So those are the activities like raising money or borrowing money from the banks. Those are the kinds of activities we're talking about for the business. Second category is the investing activities. To run a business, you need a lot of assets, and purchase and sale of long-term resources or assets like building, plant, and machinery is termed as investing activities. The third category is operating activities that are primary operations of the company. So if you are McDonald's, when you're selling French fries, that is the primary operation of the company, and that will fall under operating activity. However, if you are going to buy a deep fryer maybe or sell a building, then it will be part of investing activities. Under operating activities, we provide services and products to the customer to generate revenues and report associated costs as expenses. So those are the three kinds of activities that are measured by the accountants. Now, these activities which are measured are then communicated through a set of financial statements. And the financial statements answers questions like, how well did the company perform during the year? This is measured by an income statement, and this is just an excess of revenues over expenses. If we wanted to see how much the company has made over the period, then we have got a statement of retained earning. Then if we're talking about the financial position of the company, that is communicated through the balance sheet, which lists all the assets and liabilities and owner's equity. And we'll go into details of each of these statements as we go along. And to identify what kind of cash has been generated or how much the company has spent during the year, we prepare the statement of cash flows, which measures the cash flow from all three kinds of activities which we talked about earlier. Next is who uses this information which is communicated by accounting. First is the individuals. They need this for whether to rent or buy or budget monthly income statement, or it is used by investors and creditors. Investors want to know how much they can earn on an investment, or creditors who want to know when they are going to be paid and if they are going to be paid or if there are any risks. Then regulatory bodies like IRS and Security Exchange Commission also requires companies to publish their financial reports. The nonprofit organizations also need to file reports with IRS and state governments. Now, all this information of financial statements can be prepared by various forms of business organization, and they are proprietorship, partnership, a limited liability corporation, and incorporated companies. Proprietorships are primarily one owner business, and the biggest limitation with it is that proprietor is personally liable, and the creditors can go after their personal assets. In terms of partnership, there are two or more owners. Generally, partners are personally liable, but limited partnerships are not. Limited liability corporations, although it acts like a partnership, but members are not personally liable as the company has been incorporated. As far as corporations are concerned, stockholders are not personally liable. So in terms of liability, the LLC and the corporation provides a substantial benefit to the owners, and so does limited liability partnership provides that benefit. However, proprietorship does not provide that benefit of avoiding a liability. Now we'll talk about various concepts and assumptions on which the financial statements are based. Accountants will generally follow a professional framework for measurement and disclosure of financial information. And financial statements are prepared in accordance with generally accepted accounting principles. And these principles are formulated by financial accounting standards boards. The Financial Accounting Standards Board came up with the foundation of accounting, or a framework within which we need to consider various characteristics of a financial statements. To start with, the overall objective is to provide the potential investors and creditors relevant information for making decisions. The qualitative characteristics which are helpful are relevance, that is, the financial statement should be relevant. And second, they should be faithfully representational. That is, they are showing what they are supposed to show. It is a true picture. In terms of the qualities that enhance the financial statements further, the first one is comparability. That is, when you make the financial statements, they should be comparable across time. And it should be verifiable by an independent person. It should be provided in a timely manner and should be easily understandable. Above it, the constraint is that the cost of providing the information should be less than the benefit derived from the information. Very important assumptions and principles based on which the financial statements are prepared are: one is the entity assumption. Hard to understand, but very important principle. In this case, the owners and the business are considered as separate economic entity. So owner is different than a business. So if you are the owners for a LLC, you are different from that LLC itself. That helps the owners to limit their liability to the corporation itself when it is incorporated as a separate entity. The second concept is the going concern concept. That primarily means that over the foreseeable future, the organization will continue without any problems. Historical cost concept basically refers to the fact that assets should be recorded at their actual cost. There are one or two exceptions to the rule when we do the short-term investments. We'll talk about it at that time. And also, we ignore the impact of inflation when we are using the monetary value. Another international financial reporting standards are the standards which have been developed by IFRS, or International Accounting Standards Board, and which is trying to standardize or move the accounting standards of different countries to a common platform so that multinational companies can use a common principles, and their statements are comparable across the countries. Now, having a uniform set of high quality global accounting standards will make financial statements more comparable across borders, and most commonly used accounting practices are essentially same under both US GAAP and IFRS, and FASB is working with IASB towards convergence of the remaining standards. We'll talk about the basic accounting equation in a business organization now. Basic accounting equation, very simply put, is resources is equal to the claims to the resources. Since the organization is a separate entity, the resources, that is what the organization owns and what the organization owes to outsiders and to the owners, is equal. So what the organization owns in terms of assets is equal to what the organization owes to outsiders, that is liabilities, and what it owes to the owners, that is called the stockholders' equity. So a basic accounting equation is written as assets is equal to liabilities plus stockholders' equity. Now, in terms of assets, assets are defined as economic resources owned and controlled by the entity, which is expected to provide future benefits to the organization. Liabilities are the claims for the outsiders. So if you have borrowed from bank, the business is liable to pay the bank back, and it entails a expected future sacrifice or a payment. In terms of owner's equity, those are insider's claims, or we call it owner's claims, and this represents the stockholder's interest in the company or in the assets of the company. So again, if you apply the basic accounting equation, if you have got assets worth 1,000 and your liabilities, that is what you owe to the outsiders, is 600, then what is remaining for the owners is $400. Here is an example of what are some of the assets and liabilities for GAAP Incorporated. You've got cash, inventory, property, and plant. Again, all of those are resources which the company owns and is expected to provide certain benefits to the company in the future. Similarly, on the other side, you've got accounts payable and long-term debt payable, etc., where all of these entails a future economic sacrifice. In terms of what the owner's stake in the business is, it can be found by subtracting liabilities from the assets. So assets minus liabilities will give you stockholders' equity. Stockholders' equity has two portions, the paid-in capital and the retained earning. When we talk about paid-in capital, those are the stocks or the part ownership purchased by the owners in the company. So a company might have, say, 25,000 shares of $1 each. If you purchase the entire 25,000 shares of $1 each, you have got the 100% ownership in the company. Retained earnings for the company is the profit or losses made by the business over the lifetime, and less any money or any money that is returned to the owners. So stockholders' equity will consist of the parent capital, common stock, and the retained earnings. And as far as the retained earning is concerned, it is the income or the loss made when revenues exceed expenses or expenses exceed revenues. Dividend is not an expense. Dividend is not an expense. It is the return of shareholders' money back to them, and therefore it reduces the stockholders' equity. So what impacts the owner's equity? In terms of retained earning, revenue will increase the retained earning, expenses will decrease the retained earning, and again the dividends will decrease the retained earnings. To take an example, if you are to use these numbers and make an accounting equation and identify what are the resources, what are the assets and liabilities of the company, then here are some numbers. So for example, Blue Diamond has current assets of $360 million. Now when we talk about current assets, those are the assets which the company can convert into cash in 1 year or one accounting cycle or less. Property, plant, and equipment are like long-term assets. So you've got within the assets, you've got current assets and long-term assets. Similarly, within the liabilities, you've got current liabilities and the long-term liabilities. Current liabilities are those liabilities that are paid or due within 1 year or one accounting cycle or less. So in terms of assets, you've got $360 and $600 and $220 in other assets. In terms of liabilities, you've got $210 and long-term liability of $560. And the balance is the stockholders' equity. So 1180 is the total assets in this case, 770, and 410 is the stockholders' equity. So in terms of resources, what does the company owns? Those are the assets of 1180. Now, if the question is, how much does the Blue Diamond Corporation owes to the creditors, that would be your liabilities, which is 770. Now, if the question is how much the company owes to the stockholders, that would be your last number of 410. Now, we'll look at the various financial statements and the relationship between the financial statement. When you prepare the income statement, you get the net income or net losses, and that becomes part of the retained earnings. It increases the retained earnings if you have got the income, and it decreases the retained earnings if you have got the losses. From the statement of retained earnings, the balance goes to the balance sheet as part of the stockholders' equity, and from there the numbers would go to the statement of cash flow in terms of cash during the period and various activities that is impacting the cash. Income statement is also called the statement of operations. Basically, what does it do? It reports the revenues and gains of the period. It reports expenses and losses for the period, and it reports the bottom line income or net loss for the period. What is the distinction between revenues and gains? In terms of revenues, it is generated from the regular operations of the business. So in terms of, say, McDonald's, when they say sell French fries, burgers, etc., they are generating revenues. However, if they sell the deep fryer itself or any of the assets they have, then or the building they own, then it would result in either a gain or a loss, depending upon if it is sold for more than or less than for the book value. Similarly, expenses that relate to the revenues for that period are reported in that period. And losses are distinguished similar to gains. If you are selling a building for less than its book value, you will incur the loss. This is a basic format of an income statement for GAAP. You've got net sales. Your cost of goods sold is basically the cost of the goods that have been sold and which is reflected in the sales. And you've got other operating expenses. Once you subtract all the operating expenses, you get your net income. In this case, it is showing the 2-year or comparative income statement for GAAP. Next, we come to the retained earning. Retained earning, as we said, is one of the portions of the stockholders' equity. Net income will increase the retained earning, and net losses will decrease the retained earnings. For example, here is the format for the statement of changes in retained earning. You'll start with the opening balance of retained earning. You'll add any net income that has been generated throughout the period, and which comes from the income statement. You will subtract the losses if you had the losses. Then you subtract the dividends, because dividend is not an expense, but it is return of shareholders' money back to them. And that will give the retained earnings at the end of the year. Balance sheet is also called a statement of financial position, and it represents assets, liabilities, and stockholders' equity. Assets could be current assets or the long-term assets, and liabilities similarly can be current and the long-term liabilities. Balance sheet is good only for that particular day for which it is made. So in this case, you've got current assets which can be converted into cash easily within 1 year or less. So cash and cash equivalents, for example, are termed as current assets. Or short-term investments which are intended for resale is termed as current assets. Similarly, inventory is part of your current assets, as you intend to sell that inventory after converting it into finished goods or as it is. Long-term assets are those assets which will give you benefit beyond that 1 year period. For example, property and equipment and other long-term assets like land, machinery, etc. All those are long-term assets. Again, this shows you a comparative balance sheet, for 2 years. In this case, you've got the liabilities portion, which is the current liabilities, and the long-term liabilities. So you've got accounts payable. So if you have got the merchandise or inventory on credit and you owe someone the money for that merchandise, then it is accounts payable. Or income taxes payable, that is the taxes that are payable within a year or less. Long-term debt is those debt which are payable over multiple years, and that is part of long-term liabilities. However, the current portion of that long-term debt which is payable within this period is classified under the current liabilities. That's the first item that you see over there as $59. Other long-term liabilities are like bonds payable or debentures, etc. Total of this is equal to 4667 and 2985 for the two comparative years in this case. The last item in this balance sheet is the stockholders' equity. In case of stockholders' equity, it will include the common stock, additional paid-in capital, retained earning, treasury stock, and accumulated other comprehensive income. What is common stock? Common stock is a part ownership in the business. So as I was mentioning earlier, if you have got 25,000 shares and it is the face value is $1 each, if you buy the 25,000 shares for $25,000 for $1 each, you have got 100% ownership, and that $25,000 goes to the common stock. That is at the face value of the share. However, If the company issues common stock of $1 for, say, $5, then in that case, you are getting $25,000 at the par value and $4 as the additional paid-in capital. So 25,000 times 4, 100,000 would appear in the additional paid-in capitals. We have already discussed the retained earnings. If the company buys back its own stock, it is called the treasury stock. And once company buys back the treasury stock, those shares are no longer outstanding. So common stock, as I said, represents the par value. Additional paid-in capital represents anything in excess of par, and retained earning is the net portion of the net income that is reinvested into the business. As far as accumulated other comprehensive income and losses are concerned, these are items of gains or loss that are not allowed by FASB to bypass the income statement, and they need to be recorded directly into stockholders' equity. So there might be a very unusual loss that might take place during a year, and you do not want, since that is not part of the regular operations, it might have to be shown through the accumulated other comprehensive income so that you do not impact the regular operations of the business or the regular income statement. This is how the consolidated balance sheet for GAAP would look like. You have got the total liabilities given to you at 4667, and then the stockholders' equity has been given to you which has the component of common stock at par value, additional paid-in capital, and then retained earnings. Add the cumulative comprehensive income, and then subtract the treasury stock which has been purchased. The total is 7422, which is the same as the assets for 2012. So last statement is the statement of cash flows. As we said, there are three kinds of activities which are reported in the statement of cash flows: operating, investing, and financing. Operating activities are the cash flow from selling goods and providing services to the customers. Investing activities are for the long-term assets, purchase and sale of long-term assets and investments. And when there is a transaction with the owners or creditors, for example, payment of dividends or repurchasing the company stock, then it is part of the financing activity. So the cash flow might come from each of these activities. Inflows are added and outflows are subtracted. And total, so you will see that the order of cash flows, order of activities in the cash flow statement is important. So you start with cash flow from operating activities, that is inflows and outflows. Then you add the inflows and subtract the outflows. Same thing for investing activities, and same thing for financing activities. When you take the impact of all these three, you will see the net cash that is used or generated by the business during the year. This net cash, or the change in cash, is then added to the beginning balance to get the ending balance. So in the last year's balance sheet, your cash from the beginning period would have been 1561 in this case, and then the increase in cash from the three kinds of activity is $324 million, and the total cash, therefore, at the end of the year is 1885, which goes to the balance sheet as an asset, as in current asset. So that's how the financial statements are will help to answer various questions as to how the company is doing, etc. So this is an overview of the financial statements for our purpose. Thank you very much for listening.